When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio number 21. As we get rid of summer, it's been hot enough, hurricane-y enough, and stormy down here. The one that hit Louisiana, as the Louisianans, Cajuns, and Floridians would call, is a small one. We're used to those. Thankfully, there wasn't a major amount of damage, and to those families that did suffer, we wish our best and a quick recovery. This is the one and only John Galt, and I've been gone for over a week. As you've read my blog, you'll notice that I've had some family issues to take care of. I just want to thank everybody in the MacroEdge family, the readers and supporters, and everybody who's on X and all the various social media platforms, plus who read my blog, for the support I've received, as my mother did pass away on Tuesday night. And I wish to thank all of you for everything you've done for me. It's nice to see a big family gather around when you really need them. And that is something you can't replace. No matter how many computers you have in front of you, no matter how many people sit there and greet you at work, it's nice to have support across the universe for everything you guys do. Let's get into the markets first. The markets have rallied solidly this week, as we've all seen. We've seen that the Dow finished today up 310, NASDAQ up 114, S&P up 30. We're getting back towards the upper bands of resistance. You've seen that. Russell up 45, a nice 2% move there. Garbage for volume again. We've had one good volume day, and that was on CPI day. Please don't ask me to explain that one. I can't even begin to. The bigger issue that I see right now is that people are under this illusion that everything is okay and we're going to get through this in one piece, forgetting August 5th and other data points, including some of the other cracks that we've seen in the markets. The bigger issue right now is the dollar yen. We are finishing up right now around 140.93. Little room to run for the next hour, but the truth is we will see what happens on Sunday night. That is when Nicky Leaks, as some people like to call him, Nick Timmeros, usually receives his Federal Reserve leak instructions from JPO. You know, the sweet little emails they send back and forth to each other saying, "Dear Nick, my darling, please let everyone know it'll be okay. They can buy the garbage stocks again. We're going to cut 50 basis points." I look for that to happen on Sunday night. That is where we're going to go, and that's what's going to happen. Why? Because they have to have it. Unfortunately for them, that's going to trigger a decline in the dollar. It's going to make the yen even stronger. And once we cross that 140 Rubicon, a lot of bad things are going to start happening in the markets. The yen carry trade is just going to unwind even further because we didn't even get halfway through it with the first crash. Moving it on to the next crash, it's going to do some unspeakable damage. And if you look at what's happening in the other currencies, for some reason, pound sterling's already back up to 131. No logical reason. The British economy is totally in the garbage chute. It's trashed out. No innovation, nothing. It is a basket case. It's what Italy was 40 years ago. Speaking of which, the euro is stuck at 110. It's standing at risk. It didn't crash when they cut rates. It stayed strong. Odds are it will increase to 112 or higher once JPO makes his announcement. That's why the Sunday night Nicky leak story, which will be in the Monday morning Wall Street Journal, will be of crucial importance to markets. It will impact treasuries. It will impact everything that we deal with in the markets, commodities especially, except for oil. Right now, crude's at $69.17 for WTI. Brent's settling down around $72. The Widowmaker's at $230 BTU, but don't worry about the Widowmaker. She's got time to kill you before the winter's over. Gold is the story of the week, up $30.15 as of this moment at $26.1070 per ounce. Silver rallying nicely, up 97 cents to 31.08, and copper up another 3 cents to 4.22. Why is that important? If Dr. Copper is moving parallel to silver and gold, that means that this rally has legs to run. And gold's next real target, because you can make technical guesses, etc., gold's next real target is $3,000 an ounce. And that is when it's going to get spicy. A lot of people would think, well, you should be happy. You're a gold bug. Gold's up to $2,600 an ounce. I would be if it weren't for the circumstances surrounding the reason it's at $2,600 an ounce. We have an unstable United States government, a Federal Reserve central bank, which is willing to sit there and buy higher highs on stock markets rather than price and employment stability. We heard the unemployment report last Friday. Everyone thought, hey, everything's cured. Happy days are here again. But then the revision fest comes in, and you look at the revisions on last Friday's report, it was a disaster. And if we average the same percentage revisions in this report that we have in prior reports, the real number will be closer to what I predicted. And that is the scary part. When we start seeing new hires, including government jobs created on U3 at around 80,000, that's not sustainable. That's not a growing economy. It's an indication of a contracting economy. And before this year's out, or probably early next year, we will start seeing negative prints in employment. Mark my words, it will happen. All right. The big economic news besides that, super core inflation came in this week. Core inflation was up 0.3% month over month. Super core still over 4.5%. So cutting into this kind of storm invites a reignition of inflation. There's been no real reduction in inflation. And if you think that this is something I'm talking through my hat crazy, folks, this has happened before. And the Atlanta Fed sticky price CPI, which I follow more closely, I think it's a much more accurate reflection of what the consumer is feeling month over month, is something you should worry about. Because if you look at last month, yeah, it's down to 4.1%, but we're nowhere close to 2%. And all it's going to take is a surge in energy prices or another surge in commodity prices to bring it back higher. If you look at some of the ancillary and anecdotal data, I follow a lot of the ag websites, and a lot of the ag websites will tell you what are the prices for things like milk, eggs, etc. When you start looking at that, let's take milk, for example. It's up another 19 cents. We're looking at a chart. I'm looking at a chart right now where milk historically, and I'll pull the, and it broke. Of course. And then it'll say whenever you need to pull your chart up while you're talking on the air, it is at the highest level so far in the last 3 months. And if you look at it since the data was being tracked, this is via Farm Progress, by the way, since 2023, milk is at the highest level in almost 2 years. This is not sustainable for the middle class. They can't afford it. They can't afford any more beatings at the grocery store. So no matter what people say or do about, hey, look, happy days are here again, we're recovering, everything's going to be fine. The truth is, you start looking behind the curtains and seeing what's going on in those grocery carts. It will come back to blow up in their face. One more quick side note about gold's rally, and I have to throw this in. Saudi Arabia, it's been reported, bought 160 tons of gold in Switzerland for delivery, not to be held in Switzerland, for delivery. Think about it, folks. The West is ignoring the old antiquated yellow metal, but a lot of countries have taken delivery and removed their gold from central bank storage because of some of the shenanigans that we've seen. Also, in the economic news, Big Lots closing 344 stores in their bankruptcy and reorganization. Boar's Head in Jarrett, Virginia, closing, over 500 jobs lost. Perhaps you should teach people to wash their hands and you won't have listeria outbreaks. Just throwing that out there for everyone. The commercial debt crisis. We are witnessing something that a lot of people aren't talking about, except for the MacroEdge team and a few others. I've heard Nobody Special talk about it in his show, the Doomer News Network. We're talking about it. But let's go look at this. According to the NBA, U.S. commercial debt reaches $4.7 trillion in Q2 as office delinquencies rise. The Mortgage Bankers Association, this is from CRE Daily, by the way. The Mortgage Bankers Association, MBA, analyzed delinquency rates for 5 key investors group holding over 80% of commercial mortgage debt. Here's how they performed in Q2 of this year. Banks and thrifts, 1.15% of loans were 90 plus days delinquent or in non-accrual, a 0.12% increase from Q1. Life insurance company delinquencies fell to 0.43%, 60 plus days delinquent, and that was a decrease from Q1. The delinquency rate on Fannie Mae stayed steady at 0.44% for loans 60 plus days delinquent. Freddie Mac rates rose slightly to 0.38%, 60 plus days delinquents up 0.4%. And CMBS delinquencies rose significantly to 4.82% for loans 30 plus days delinquent or an REO, an increase of 0.47%. Now, if you look at the office loan situation, which is $740 billion of the total mortgage debt, according to TREP, the office sector special servicing rate hit 11.91%, the highest level since 2013, with $1.4 billion in loans transferred to special servicing. Multifamily special servicing rate also spiked in August, rising 60 basis points to 5.71%, the highest in 9 years. See, we're no longer able to say since COVID. We're no longer able to sit there and highlight since the COVID era. We're starting to get back to referring to the great financial crisis. Commercial real estate's still in trouble. Another reason why, especially why, they desperately need a large rate cut to lower refinancing rates and give the markets a breather. They know full well what's about to happen. They don't want to hear about it. They don't want to advertise it. They don't want to broadcast it on CNBC or any other of the major networks. But this story is the one that's going to put the regional and community banks on the front page, especially when they have to start failing them and taking them over. Why won't they take them over now? What's happening November? That's right, an election. They will do everything they can to prevent massive bank failures and taking them out with the FDIC funds, deficiency fund, and insurance, They'll do everything they can to avoid that. They will paper over the losses. They'll say, we've made a deal. We gave them a big hug and they're feeling better. We're not going to process bank failures until after the election. And when we do, odds are we're going to see a substantial increase in the number of bank failures, and it's going to get ugly. We're hearing stories now about credit unions seeing increased delinquencies, lower out loans for credit unions, for automotive, commercial, etc. Once you start seeing this trend, it only increases exponentially. We were talking about this in the MacroEdge team, folks, and if you're not a subscriber to MacroEdge, go to macroedge.net/ozone. Read what we talk about amongst ourselves and read exclusive information that can help you with your trading decisions. That's macroedge.net/ozone. You want to know what's going on, and it's important to know what's going on. The folks who think that we're just throwing this out here for the heck of it and we're just nonstop doomers, we're reading news. We're developing economic opinions. Let's take another story here. You never thought this would be a big deal, but California. This is from Credit and Collection News. Bankruptcies and foreclosures hit a 4-year high in California. Did you see that on your local news last night? Probably not. Was that part of your investment meetings this morning? Probably not. Now, granted, they're still below great GFC levels. But a quarterly analysis by the Federal Reserve Bank of New York examining bill paying habits in several states, including California, reported that in 2024 Q2, 40 personal bankruptcies were being filed and 12 foreclosures were being entered per 1,000 people. Just like 07 and 08, it starts slowly and then it furballs. It wasn't the peak, though, until 09 and 10, when the banks were given a green light to clean the books, clean up the records, get back ahead of it and get bailed out. This is the kind of news that people need to pay attention to. And this is the problem that's being muted by the mainstream for election purposes and for other insane purposes. We want you buying stocks. We want you buying homes. Yet mortgage applications are still bouncing off 1995 levels for new homes. There's no commitment. There's no follow through. It's just like the volume on the stock market lately. You get a couple of days of just tremendous volume, and then everybody plays their ZDTE 0-day options. God, I'm having a terrible time today. Sorry, guys. And it's causing distortions in what's really happening of the economy. This economy has bifurcated. If you're in that 1 to 5% of the wealthiest Americans, you're doing fantastic. You don't care, but you have stopped your spending. You've slowed it down. But if you're in that lower 90% of society, you're budgeting everything. You're not looking to buy a home unless you have to. If you have to sell a home, you're trying everything you can to not sell it for a loss. Your insurance prices have skyrocketed. And now we're starting to hear a new subject we haven't heard in a long time from our friends at Calculated Risk. Interesting story headline and story behind it. CoreLogic reports 1.11 million homeowners with negative equity in second quarter of 24. Now, CoreLogic released their homeowner equity report for the second quarter of 2024. The report shows that U.S. homeowners with mortgages, which account for roughly 62% of all properties, saw home equity increase by 8% year over year. Fantastic. But there are still more people upside down and growing. That is another trend we saw from 07, 08, 09, and on. And that's what suppressed home purchases right up through 2012 and 2013 when more incentives were added, manipulation of the credit reporting services to give people better credit than they really had, and thus igniting the future boom in 2020, 2021. Now that bill's coming due, and it's not going to be a good situation, people. It's going to end in tears for everyone, whether it's a bank, whether it's a realtor or a home builder. We're seeing more of the videos coming out on social media of the home builders. I'm not going to mention names. You can find them yourself. They're on TikTok, X, Facebook, you name it, of the lower quality homes being built. Big builders, some of the big boys. And you're seeing the defects everywhere. Windows not square, doors not square, leaking, cracks, etc. This was the same poor quality we witnessed in Florida in 2007 at the end of our quote-unquote boom. When you see this kind of just piss-poor workmanship being applied across the board to get the job done, get the house on the market, and get rid of it so the builder's not stuck with it, you begin to understand how we ended up with a crash. People just said, I'm not going to buy this garbage. I'm not going to buy the garbage that you had a month ago that was built 2 years ago. People started to identify why things deteriorated in quality and why people didn't want to sit there and purchase homes from certain home builders. That trend is going to continue. We've also had another situation that no one's paying attention to. CNBC actually had a personal finance piece by Anna Teresa Sola. Homeowners may be overconfident in their retirement readiness, economist says. Here's why. Angie Chen, a senior researcher for the Center of Retirement Research at Boston College. Everyone says they think that having a home is the investment that will help them retirement. But she said, quote, homeowners are actually more likely to be overconfident in their retirement readiness. There's a lot of misconception in terms of how people access whether they're ahead or not in retirement. If you need to understand that concept, if you are retired and you owe too much on your home and you don't have the funds available in your retirement, or there's a recession, or tell me if you've heard this before, a downturn in the markets, not just real estate, but equity markets, that puts pressure on your holdings, you're going to have a major issue. And now I have got to introduce one of our favorite guests here on MacroEdge 6. 6, are you there? And of course, it's not coming through. Oh, well, I think he's there. Let's see if this is going to pop in here. 6, if you're there, go ahead. I'm going to sit here and take a second to listen. There we go. Now we got him on the air, folks. 6 is going to talk about stocks probably in the same kind of rant that I did, but I want to let him take it away for a few minutes. What do you make of this market action this week? Do you think this is a Fed and a prayer action, or is something bigger lurking next week?
Well, we got the double bottom on Wednesday. They rallied it off slightly higher than the low, and then just the way that the market bid all week doesn't really look to me like it's real buying. There wasn't a lot of volume. Every single dip, there were multiple strange candles in the last few days where the market would dip, where ES would dip 15, 20 points in 1 minute and then immediately get bought back up. It's just very robotic, very algo driven this week. It doesn't look like the real big players are doing it. The volume's so low. I don't think it really means a lot. We're so close to the all-time high now that would be the foregone conclusion, but it's hard to really know. I don't think there's really too much to do on either side until we have the Fed meeting this week. The rhetoric around the rate cuts will kind of set the tone for the market. I'm trying to stay pretty light in my position sizes in my personal trading until we have that guidance from the Fed. I don't see much to get excited about. The rates have bid a lot. USD JPY has tanked. I mean, the yen is very strong right now against the dollar, which is surprising because it already took out the lows of the panic at the beginning of August. Yet stocks are just grinding higher and higher each day the last few days. Not sure really. I'm not really sure there's much to do until we have the Fed meeting, to be honest.
My opinion now, I'll love to get your take on this.
I don't
the
think
Fed will do what it'll. Can you hear me?
Yeah.
Go ahead, 6. What I was going to say is it would appear that the Fed meeting is going to do what the Fed always does, and that is screw up. And I think that's going to come in the speech and the economic projections, which are going to scare the hell out of the markets. A lot of us believe we've been in a recession since the spring. I still say it was April, May. Others are saying the first of this year, end of last year. It's apples and oranges until the NBER decides to sit there and make up a date and apply some data that fits their narrative. When they have that speech that afternoon, is that when you think we're going to see the action really ramp up?
Oh yeah. I think you're going to see huge amounts of action when Powell starts talking. If he goes with a 50 rate cut, maybe a huge spike for a little bit, and then probably a sell-off after that. I'm not sure it's going to be interpreted well. I mean, everyone thinks that really, so it's not really anything unique that I'm thinking. A 50 is pretty bearish in my opinion, because that all that says is why didn't you cut in July? What I'm really interested to see is their projections, because they had unemployment ending U3 unemployment ending the year at 4.1. It ticked up to 4.3, ticked down to 4.2. But you have U6 unemployment that's now ticked up as well on the last one, while U3 ticked down. You have the jobs reports. The weekly sets lately have not been so bad. Non-farm payrolls is pretty bad. JOLTS was bad. The revisions are bad. They're definitely behind the 8 ball here on rate cuts, and I'm sure that they know it, and that's why there's even discussion of a 50 basis point rate cut. The odds are 50-50 on which way to go, and they're probably not sure what they want to do yet themselves, and that's why you have Nick Timiraos putting an article out in the Wall Street Journal that basically says that. So I guess probably see somewhat of a split decision from the Fed this week. And then, depending on what they do, probably have some serious action. There's going to be a lot to do in the trading world in stocks next week. But until then, I guess we'll have to see.
But my opinion on where this is going to head, the reason I'm bringing this up in the way that I did with the Fed is we've already seen the disinversion since I've been gone. With now we're at a positive 0.7% on the 2s, 10s.
Yeah.
If we're to suddenly see their cut of 50 and a bearish statement and 10s sell off because of the short-term financing habits of this administration, I could see a formula for a massive move in financials and tech at the end of next week, especially if we see that blow out over my magic number of a positive 0.25% bear steepener.
Yeah, I mean, absolutely you could if bonds really sell off on a 50 basis point rate cut. But I'm not so sure you're going to get that just because if conditions really unravel across not just the U.S. economy but global economies, I mean, we're late to the party on cuts. ECB just cut again. Canada's eyeing up a jumbo rate cut potentially in October, maybe December. And other countries aren't that much better at managing their finances right now. The whole world is pretty levered up from personal balance sheets to government balance sheets. And I mean, I wouldn't park my money in any other country right now. So despite the U.S. government's reckless fiscal habits, at the onset of what's projected to be by the SOFR curve, a substantial rate cutting cycle, I definitely would own bonds for that, and I do.
That's pretty much where I'm at. I'm staying in full disclosure, personal retirement account. I am only long short-term bonds and plays and gold right now. I'm not going to sit there and gamble on equities yet. I'm not even gambling on gold stocks and silver stocks yet because I still think a rug pull is possible from the Federal Reserve, and that would distort that part of the market even worse. On the flip side, if the behavior of the Fed continues, $3,000 gold is a lock, and that has greater implications for the dollar's valuation than anything, in my opinion. What do you make of the prospect of
from the second?
Captain? Hang on just a minute, please. Six. What do you make of the prospect of the dollar yen breaching the 140 level substantially?
Oh yeah, I mean, I'm long the yen. I've been long the yen since 147.5, and I mean, I think if they cut by 50, it'll do it that day easily. And I think that when that happens, you'll see the Nikkei start to sell off, and maybe that leads to another kind of repeat of what we saw late July, leading into August 5th. But I guess we'll have to see.
Yeah, I think that's going to happen Sunday night with Nicky Leaks when he puts the strongest article out, the usual Monday morning quarterbacking article where he telegraphs the Fed's move. I really believe that's when we're going to see it.
Yeah. I mean, definitely looks possible. The yen's been pretty strong against the dollar.
Sir,
I did.
Go ahead. I'm sorry.
Okay, Mossad sent the information that they starting the war with Hamas.
Hey, Captain, hang on a minute. Let me finish up with Six. Just 1 second. Six, what do you think of the possibility? And since you brought up the July-August scenario to start that up, what is your strategy for the MacroEdge group as far as safety first, or are we? You tell us. You let the group know, because we haven't had a chance to talk about this in a while. Vision's been doing really well. The MacroEdge.net team is just thrilled with how things are going. Go ahead, let everybody know real quick.
Yeah, so right now we're in a bit of a drawdown. Unfortunately, we're still up 39% since we began in April. It was up to 47% at one point on Wednesday morning, actually. And then that reversal kind of kicked us in the teeth on the short ES position. But that is hedged at 56.20 ES with the calls that are 7 days out from today. So we're all right there, but we gave back a lot of the gains on that short on this pretty aggressive turnaround rally. But the yen position is doing very well. We're long the yen via 6J futures with notional value of 200% of the fund. So we're doing okay in that arena. Long Exxon, which is offsides, still short the regional banks. That's a little bit offsides, but less so than it was before. And then have a lot of still money market exposure. And then we have a large position in 5 to 10 year bonds as well, and that's unlevered.
I understand. Six, thank you so much for participating today. I am going to move on to one of our listeners. Captain, what is your question, sir?
Not the question, but I have information about the situation. Mossad just started the war with Hamas.
Interesting. I think the situation with Hamas is just about over for Israel and Hamas, but there are reports they're getting
Mossad just sent the information on the Twitter. You can see.
Okay. Bear with me a second here. There we go. Pretty much the only information I've got in the Middle East right now as heading into this program is that we had a shift where Israel is reportedly getting ready to open her front up against Hezbollah. All right. Thank you for your participation, sir. And Mr. Awesome is in the bullpen. I'm going to see if he's available to talk real quick because I brought up commercial real estate for a reason. I mentioned California bankruptcies and foreclosures. I also have some interesting discussion to have with him about the yield curve, because what we're seeing now, whatever. Okay. That there's a disagreement here from ALMglobist.com. Eric Sherman wrote an opinion piece on September 9th stating that the yield curve is moving back to normal. Does it matter anymore? And then there was a large discussion involving our friend Kalani and some other people online. Oh boy, was that interesting, where the discussion hit that people don't want to, they want to talk their book more than they want to sit there and be more distinct about where things are heading. One of the things you have to understand about the yield curve, if this bull steepener accelerates and this disinversion continue, I mean, the disinversion continues to skyrocket as a bear steepener, this will mark the end of the longest inversion of 2s10s since the Great Depression. It's a duration issue. And for people to say, well, it's not a risk issue, is the most asinine comment I've ever heard in my entire life. The risk is that you get a longer and deeper recession. And if someone says, well, it's not a risk issue, has anybody looked at commercial real estate? Has anybody not paid any attention to what has been happening to the regional banks? And does anybody really understand what's going to happen when residential starts to accelerate in default and all of the Airbnb millionaire kiddies who took credit card loans out to put down payments on homes start to default at an accelerating pace? Everyone's under the belief that the government's going to bail them out. Our government can't even agree on a budget extension, much less the concept of creating any kind of program to save the bacon of a 28-year-old Ferrari driving Airbnb millionaire who makes videos and probably will end up promoting real estate seminars. Get scared, people, because this is one of the most speculative bubbles I've seen since 2007 and 1999. But this is one of the craziest times I've ever lived in, where we've speculated on crypto, we've speculated on blockchain, we speculated on COVID drugs. Now there's an Ozempic bubble. Oh, will I be running a nice article on that from my pharmaceutical experience? And commercial real estate. We have people trying to say that commercial real estate is going to be fine because you're going to convert office buildings and hotels into residential. Now, the guy who's about to come on the air with me might have thoughts on that. Mr. Awesome, how you doing this afternoon?
I'm doing good, John. How are you?
Yeah, I'm here.
Yeah, I hear you.
But
Well, I'm coming to
I'd like
life
to
in the
get your
field
thoughts on
today.
that. Yeah, I'd love to get your thoughts on the idea and the concept that, oh, commercial real estate's no big deal. We'll just convert it into housing.
Yeah, no big deal. Just a lot of buildings that don't work that way, and I'm not sure who wants to lend the money to do it, but knock yourself out.
What do you
The
make of
reality,
the impact of Big Lots closing 344 more stores and top of
yeah,
the problems with everything else we're seeing in retail, office, and multifamily?
yeah, retail had a bit of a respite for a minute there, where it seemed as though it had stopped with the closures and wasn't facing as much pressure, but now we have multiple $500+ million restaurant bankruptcies. We've got Big Lots going out of business. And ultimately, what that does is it puts vacant space on the market. And I don't see that there's an immediate demand to fill those spaces. And there's probably going to require a lot of work from some creative real estate leasing teams to fill those spaces.
What do you, I was watching the number of hotels suddenly that are going to special servicing.
Yeah.
That's a little unusual at a quote unquote market top for equities, but it's even more unusual in my opinion since we were all told America had this revenge travel bug and it would take years for it to play out.
Well, I think we saw it play out. I mean, there was definitely some revenge travel going on, and I think a lot of people decided, hey, after everything we just went through, we're going to go take vacation. We're going to go see different places, and that was great for the economy. But now that that's drying up, it's the flip side of that. A lot of the hotels were financed using short-term debt, sometimes floating rate. So there's been a lot of pressure on those as rates have gone up. They have had to extend or default, or they're handing keys back to lenders. The commercial mortgage-backed securities have actually been increasing this year. But one of the things that I've been waiting for was, and unfortunately it's a bit backwards looking because that's how the government publishes it, but the mortgage asset transactions from origination to secondary transactions. And the Federal Reserve tracks this and they publish it quarterly. And multifamily and residential saw a small increase, but the remaining set of sectors, including commercial, continued its downward trend. And it's actually the volume of transaction that's drying up is drying up faster than 2007 into 2009. So take that as you will. But they finally published it. They published it late. So one more piece of government data that got delayed by almost a week. Take that for what it is as well. Unfortunate situation.
With the risk of a 50 basis point cut, and I call it a risk right now because of how they will present the cut. When people seem to think that is a Band-Aid for housing.
Yeah.
But in reality, I've heard that. You've heard it too, right?
Oh, yeah. All the time. Just wait till rates drop.
Yeah, except what if it's a 2-year rates that drop and the 10-year gets back over 4%? That blows up in their face pretty dramatically, if I'm not mistaken.
It would, given that most 30-year mortgages are priced off the 10-year Treasury rate, and basically the basis in between what they can earn on a Treasury versus lending the money out, which I would argue, while it's been a popular trade for a long time, mortgages, it's not a lot of return for the risk, and it certainly doesn't keep up with inflation over the course of 30 years. But I don't see that is going to be the boon for housing as it is, because, and this is kind of a frustration that I have. There are several really intelligent economists and people out there in the world and paying attention, probably more so here on X Twitter than anywhere. But it's this idea that the Federal Reserve raising and lowering rates isn't to alter monetary policy and to get people to stop borrowing money at such a rapid pace, and then start again when they want to start the credit cycle again to prevent inflation from getting any worse. But if they're dropping rates, it's because they're now focusing on employment. And if unemployment is rising, that's not going to help the housing market in any way, shape, or form. It never has and it never will. It's that simple.
And of course, if we see that collapse accelerate, which we're already seeing in Florida, Texas, and several other states, and apparently California is starting to join the party, would that not mean we'll see more negative equity scaring off even more buyers? Because who wants to be the person to buy a home that's worth $10,000 less the next year?
Sure. And I think that the general population is looking at things, and the reason why the housing transactions have dried up so much in existing residential, or as I like to call it, used, is because people are going, I'm not paying that price, or I can't pay that price. And dropping the 30-year mortgage, half a percentage point isn't going to make the difference between what things have been priced at to reopen the floodgates of buying and selling. It's just, that's not enough. There's negative pricing power in home building, and prices have been dropping for 2 years in the home building space. Now, that's been noticeable across the entire sector, not just from the big builder standpoint, but people building houses, right? They're hiring a contractor to build their house. That's actually seen the biggest drop off over the last 2 years as far as volume goes. And everybody except for the 7 largest publicly traded home builders is facing both margin compression, price impairment, and are actually building less. And inventory is at a point where we haven't seen it in a long time as far as spec homes. There's over 100,000 spec homes sitting out there on the market. That's only happened in recessionary times. I've got a chart on it I wrote for MacroEdge a while back that as well as the Cantrell rule, as well as the SAM rule or the McKelvey rule, whichever you want to choose, there's also a housing rule. Anytime there's 100,000 specs on the market, we're in a recession. It doesn't happen outside of that, period, ever. So even from the home building standpoint, things are looking as though we're in recession, and I don't see that we're on the end of it. But when we do, I'll be the first person to say, hey, things are looking up.
I'm right there with you. And usually Florida is a good predictor of tops and bottoms in a housing cycle. And we're somewhat overdue from the speculative boom from the last 10 years. I'm right there with you and saying, yeah, I don't see a bottom, at least my speculative guess, 2028 at the earliest before we see this bottom out, because there's going to be mass liquidations. And like I was talking about earlier, I don't know if you heard me, the quality of some of those 7 publicly traded home builders has deteriorated significantly in the last year and a half, 2 years. And talking to subs and people who are still in the industry, I'm hearing horror stories about cost cutting to keep margins higher. If that validates, we're going to see a nightmare scenario on warranty issues and developments, and finally governments looking to crack down and raise revenues by fining them for actually making poor quality homes again.
You're probably going to see some of that. I can attest from having been at a publicly traded home builder a couple years ago. It was in my almost 30 years of experience. It was probably the craziest thing I've ever seen in real estate or construction, in the demand, the amount of closings that were going on every day, and what was asked of people in the field to keep their normal quality controls in place, when not only was the production level insane, we almost matched the GFC height of housing units under construction for single family homes for sale. We've actually built more housing, including multifamily, over the last 2 years in any time in recorded history. Since permit tracking has begun, we've never built any more, even in the 70s. So it was an extreme time, and a lot was asked of people to do their normal job in a very bizarre and strange environment. So there probably is going to be something of that nature, at least from people that were buying new homes in 21, 22, because it was really difficult for everybody in the industry to keep their head straight. I mean, it was literally whiplash from everybody out in the field to even at corporate headquarters.
Okay, well, I'm going to bring Six back real quick with a question for both of you. And this is the thing. We're starting to see deterioration in retail at an accelerating pace. hints of a recession and the lower 80%, 60%, whatever number you want to peg of society, having difficulty making ends meet. All that being considered, if we have a bad retail season, is this the economic nightmare scenario for not just commercial real estate, but residential, as people will choose what they can and will pay on? And I'm stating this with auto delinquencies and repossessions starting to skyrocket, especially in several parts of the country, in addition to bank problems that have been papered over. This is becoming a giant nightmare that I don't think Wall Street's ready for. What about you, Six and Mr. Awesome?
So I only know it from the market perspective. That's where I spend the majority of my time, looking at charts, looking at all the different corollaries of asset classes. But I mean, it certainly will. But I think the best explanation of what we have going on here, and it's kind of funny if it's not so sad, is if you overlay the chart. I'm sure most of you have already seen it, of for the Ferrari stock chart overlaid with the Dollar General stock chart. That tells a pretty good story of the disparity between the two classes right now. And I mean, retailers look pretty bad at the moment, and but I'm not so sure how much of an immediate effect that has on the market at large, just because the big tech companies are doing the whole AI thing, which, I mean, is they've obviously taken it way too far in terms of price of these companies and the valuations. OpenAI funding at $150 billion valuation. Tiger Global wants to buy in on that. They've been wrong. They've been wrong before quite a few times.
Sold to them, by the way.
Yeah. Yeah. Tiger Global. They what did they have in 2022? Like a 58% drawdown. I mean, they used to be one of the best, but now they're one of the sheep at this point.
Mr. Awesome, what do you think?
I think the nature of recession is beginning to show the disparity that's probably always been there. The difference being people that are tapped out don't have the access to credit anymore, or the ability to take on more credit. Whereas in an expansionary cycle, people seem like they're doing fine, but really they're just borrowing more until recession hits, and then that changes. And we're probably going to see even more than that. I mean, I don't think that we've reached the depth of the recession or where it's going to go to. I certainly don't think that we passed through it. So yeah, we're probably going to see even more pressure on folks that aren't earning as much, and on all of the goods and services that are marketing to general public. It's this unfortunate reality, but even in the home building world, there's builders can't build something cheap enough to get to where they need to. They're still using incentives just to get people to buy houses. With apartments, a lot of the apartments nationwide permits are falling off. They're not starting anymore. They're finishing what's out there in the pipeline because they're not seeing the demand. A lot of the developers that I've worked with literally say they're not going to build the project until both rates come down and incomes go up. So savvy investors are seeing, the signs of this isn't going to work at the moment, so they're looking for something else. And then, that's also going to put more pressure on unemployment when construction finally turns the corner and lets go of people. That's going to really add pain, unfortunately.
Well, this is my terrifying thought, and Six, toss your market insight on this. I think the Fed's going to cut rates severely in the next 3-4 sessions, and we're going to end up with a stagflationary recession that could last years. Now, most people don't know how to trade a stagflationary recession because, let's face it, most of the kids, and I'm using that because I'm older than most of you guys, have never been in a sustained cyclical bear market that's lasted for a decade plus. What would the reaction be if we hit that type of scenario where there's cycles of inflation, contracting growth, a little bit of growth, more inflation, et cetera, over just say 2 years? I don't think the people are prepared for that. I don't think the mindset's prepared for it. And I think the lack of education of what's happened in the past is setting up markets, both real estate, any asset, just screw it, every asset class is not set up, no matter how much technology we overlay on it, is not prepared for a stagflationary recession.
I mean, I think that if something like that were to happen, you know, Robinhood and Webull can kiss his client base absolutely goodbye. They do not have the attention span, nor the willpower, nor the firepower to continue to operate in an environment like that. The recency bias in the markets is absolutely insane. People forget that things don't always go up and to the right. And by the way, I categorically and violently reject the notion that both me and this group is a group of doomers or perma bears. When the conditions look right for a sustained bull market, I will be right at the forefront of that, buying with leverage. But I don't see it right now. The price action the past few days might have been bullish. Sure, I may have I been caught off sides the last few days? Absolutely, I have. But I do not see a long sustained bull market ahead of us. When I do, I will be buying as fast as I can.
And I'll be right there with you, sir, because I made an observation during my week of hell where I observed that the only last time we had a series of 2% moves up or down or greater was 2008. And most people think, well, 2008 was a banking crisis. It was an asset crisis. And every asset class paid a price, except for gold for a while, because people were fleeing to safety. People fled to bonds because they knew that the Fed would buy them. So they were willing to accept a 0.5% return to preserve capital. I agree with you on the recency bias. That is one of the most outstanding comments I've heard. Folks, if you're trading on recency bias, you're going to get smoked. And remember something. In the old days, I know I sound like Grandpa sitting in his rocking chair with a corncob pipe in his mouth when I say that. You weren't allowed to use credit cards to open up trading accounts. You had to have the cash. You had to have the money. So when we're using credit to sustain an equity bubble, to sustain a crypto bubble, to sustain a option bubble, at some point there's going to be a mistake and there's going to be consequences. And what would happen, in your opinion, Six, and I'm going to let you go after this, if we were to get a serious 5, 7, 12% correction day, and then the margin calls went out to these Robinhooders? I don't think they're ready.
Oh my God, not just them, but the day that we were set to open down like 4%, I think it was August 5th, that day, they were massive amounts of big players. They were short so many options on SPX that were so far against them. And I'm not going to run with the conspiracy theories, although I did think it was very odd that all of the retail brokerages had power outages that morning and system outages that locked people out of their accounts for hours. And then all of a sudden we rallied after that. Never mind that. It is the options bubble is so big that if we had a limit down day, all of the sold puts would be a catastrophic loss for the sellers. Absolutely catastrophic.
Well, we've never seen an unwind, and I hate using this reference because. Go ahead.
One more thing: the amount of speculation in options right now is. We're setting ourselves up for a repeat of the portfolio insurance debacle of the Black Monday crash of '87. I'm not saying that that's what's going to happen, but an options-driven gamma squeeze to the downside will be the boogeyman, if there is one to be.
Amen, sir. 110% agree with you on that, because I remember sitting on a boat watching the phrase "limit down" put on a little screen, thanks to our access to satellite, and we haven't seen a limit down day in the futures, folks. When you turn your TV on at 4 a.m. and see a limit down day, the entire options market is going to absolutely freak out. And you're right. Conveniently, a lot of the major retail brokerages were out of position and failing. I blame it on sunspots and perhaps somebody spilled a Pepsi on a keyboard somewhere. Who knows? Let's wrap this show up. I wish to thank our guest today, Mr. Awesome at 6. I appreciate you chipping in, helping me out during this period because I had questions. I needed information. We're seeing where the bubble is winding up. And I'm going to make a quick commentary of what I see happening in the next 45 to 50 days, trading days. We have an election coming up. We have a Fed meeting coming up. There's a terrifying prospect that the Fed will say something, do something, or post something in their outlook of future economic projections that will trigger a sell-off. All of that is a legitimate concern. What's more important, though, is to watch the currency markets and the credit markets. Bonds are telling you something. We're currently operating at a price-earnings ratio above 27 on the S&P 500 based on the 20 rule. We're also way out of bounds on the Buffett rule. If you look at everything that Six was talking about, if we get a major gamma event, there is no bank, there's no one in the broadcast media, and I'm talking about the bubble visions. Yes, I know that's an 0809 term, and I'm showing how old I am again, but let's face it, financial media is designed to sell you a product and encourage you to spend money you don't have and buy things on margin you can't afford because that might be the lottery ticket. If that lottery ticket goes bad, well, they just don't submit a 10K, right, SMCI? And you can sit there and see blowback right into your face of such proportions where you could create a jog to the banks, which could become a run, if there's enough panic. The average person doesn't understand how the financial system works. We've seen witness to that this week on TikTok and on X and on Facebook, where you see people who found a quote-unquote flaw in the Chase ATM withdrawal system, and they were able to transfer all this money over, and they said, well, it's their mistake. I don't have to pay it back. Believe it or not, folks, there are people who are actively trading equities, options, futures, commodities, God help them there, who think that you can sit there and use that excuse, it's their mistake, so I don't have to pay it back, and calling it a day and thinking there's no one going to reach out and touch them. Now they're finding out that Chase is going after them. Now they're finding out that they have to pay back the tens of thousands of dollars they spent on crap. And now they're finding out there's criminal penalties for their activity. This time there won't be criminal penalties for stupidity. There will be financial punishment dealt out. In our lifetimes, we've never really had risk assessment properly defined by the markets. If you make a bad bet and you lose the money, you don't get a kiss on the forehead from JPO and a wad of 100 slipped into your pocket. If you make a bad bet, unless your name is Nancy Pelosi, and you need to make it up, you don't get inside information to sit there and make another trade to offset it. Right, Mr. Bostic? You start adding all of this up, and you realize that the system is not designed for the person who uses a Robinhood or a Schwab or a Thinkorswim, which used to be so great. And you understand that when the systems fail, the penalties this time are not going to be imposed on the biggest of players. Oh, yeah, they'll trot some poor SOB out there and put him in handcuffs just like they did during 09 and 10 and say, he caused all this. Not one CEO went to jail. Not one CFO went to jail. No one who created the dramatic financial problems through their use of exotic trading instruments was penalized. But I can guarantee you that the middle class and lower class, and worse, the growing retirement class will pay that price, will be penalized, and will not get a kiss on the forehead, will not get a bailout and will live the remainder of their lives in poverty. That's why it's important to read real news. I'm not a doomer. Go ahead, Six.
Yeah, one more thing, just for our listeners to watch if there is a real problem in the credit markets upcoming. To watch when things really might be about to start hitting the fan. In leading into the great financial crisis, LIBOR, the London interbank offered rate, the unsecured short-term funding rate, randomly jumped 10 basis points intraday for no real perceived reason. That was the canary in the coal mine for that event. Right now, they've transitioned from LIBOR to SOFR, which is secured overnight funding rate. But now we also have Ameribor, which is unsecured debt for short-term funding. If I was concerned about credit problems, I would watch the Ameribor rate and watch for random jumps in that rate. That would be, and credit spreads. That would be the canary in the coal mine for me.
Thanks, Six, and I appreciate your participation today. And folks, real quick, he's right. Ameribor, I watch one more indicator. If you suddenly see the 30-day bill blow out to a 6-7% rate because of government stupidity, which we see every time, whether it's extending the debt limit or whatever, people will sell short-term, buy intermediate. They'll sell long-term, buy short-term. But when they're selling everything, we can all panic. And what we saw on August 5th was across-the-board selling of everything, every asset class. He is 100% correct. Watch the Ameribor. It's a great indicator. It's one that doesn't get enough attention. And it also will tell you where liquidity is in the market that day. One more time, macroedge.net/ozone, macroedge.net/ozone. Subscribe today for a 2 free week trial. Get the information that you need to stay ahead in these turbulent times. For MacroEdge Radio, this is John Galt speaking. Good night, everyone.